But retirement is when you're going to transition out of teaching into living off of those investments. So how do we get there? We have to know how much we live on each year, when we want to stop working, and the best investment vehicle to get us there. Welcome to the Teacher Money Show, a podcast dedicated to helping teachers navigate your unique financial challenges and unlock your financial superpowers. I'm your host, Shaun Morgan, a full-time teacher. That's right, I teach every day just like you, and personal financial coach. And I'm here to help every teacher, whether you're a seasoned teacher looking for fresh insights or a new educator navigating your first paycheck, to have a richer wallet, classroom, and life. The contents of this podcast are informational in nature and are not legal or tax advice, and neither I nor my guests are engaged in the provision of legal, tax, or any other advice. You should not act upon this information without first seeking appropriate advice from an accountant, financial planner, lawyer, or other professional. We're continuing our series of financial basics that I've been doing since the beginning of this podcast today. So it's just me and you today. But before we get into that, I just want to remind you all that I'd appreciate it if you take some time to follow the show in your favorite podcast player, whatever that may be, whether that's Apple or Google or Spotify, however you are following this. But that way it helps boost the show, and take the time to leave us a review or something like that, just to help us get more teachers able to hear about the show, so that way we can continue to grow. I would really appreciate that. All right, let's dive right on in with what we're talking about today. We're going to be moving from getting out of debt to investing for the future, because once you are saving money, you're able to pay down your debt. And once you've paid down debt, you're able to really aggressively invest for the future. You definitely need to consider investing for the future before you have gotten completely out of debt, because that gives you time, and compounding interest and things like that are really helpful over time. So please don't neglect investing entirely until you're out of debt, but debt needs to be your first priority when you are in debt. Now that you're out of debt, or you're going to be out of debt, you can start focusing on investing just a little bit right now while you're still in debt. And then when you're out of debt, you can take all that money you were paying towards your debt, or most of that money you were paying towards your debt, and now roll it into your investing for the future. So you need to invest in the future. What do you start with? Well, I recommend you start with 3 questions. First question is, how much do I need to live on each year? The second question is, when do I want to stop working? And the third question is, what is the best investment vehicle to get me there? So we're investing for the future. We're investing for retirement, whatever that looks like. Retirement is a word that's full of a lot of things. Like, we picture an old person sitting there watching, Jeopardy or whatever. Maybe that's just me. That's not what retirement has to be. Retirement is, when are you going to start living on your income from your investments? That's what retirement looks like. Now, that doesn't mean you have to only live on your income from your investments. You can have like a part-time job or work for a passion project and still make some money on the side during that. But retirement is when you're going to transition out of teaching into living off of those investments. So how do we get there? We have to know how much we live on each year, when we want to stop working, and the best investment vehicle to get us there. So let's start with the first question. How much do I need to live on each year? Well, to be financially independent, you must balance the FI equation. I know that sounds scary, right? If you're one of those English teachers out there, you might be like, oh no, math. Don't worry. This is math so easy, an English teacher can do it. I know that's kind of rude, but I've had multiple English teachers tell me that they don't do math at all. So it's just a little joke, I say. The FI equation is, your passive income must be greater than your expenses. If the amount of money coming in from your investments every single month is larger than how much you spend every single month, you are now financially independent. You don't have to work anymore. It's as simple as that. So we have to figure out, well, what are those expenses, right? Don't just throw out a passive income number and be like, I want to bring in, $100,000 a year, or $50,000 a year, or $70,000 a year. Like that doesn't mean anything, because if you spend $150,000 a year and you bring in $100,000 a year, you're not financially independent. But if you bring in $70,000 a year, but you only spend $50,000 a year, you could have been financially independent years ago, probably, because you weren't basing your financially independent number on what your actual real expenses are. So you need to figure out your expenses, and your expenses are just what you spend every single month. So if you've been tracking your spending, you should have a general idea of what you are spending each month. This is not your income, okay? Because let's say you make $65,000 a year, but you are paying into health insurance, and you're paying into your retirement accounts, you're putting money aside for your kid's future, you're doing all these other things, all this money's coming out of your paycheck. And let's say when you retire, you get benefits from Medicaids that cuts part of those healthcare expenses maybe, or you have a different healthcare option now, or now you're not putting money into retirement, you're not putting money aside for your kid's future anymore. Those things don't apply anymore. So you don't want to base your number on your total income. You want to base your number on how much you actually spend. So make sure you track your spending to discover how much you are spending every single month. And I would do over the full 12 months, okay? Because some months are good, some months are bad. And having that average number is going to be much more helpful than just saying, oh, this month I spent $4,000, so that must be what I spend every month. It's probably not the case. And just make sure that you're being realistic, because if you are spending $3,000 a month, but you are doing nothing fun and you don't like your life, saying I can do that for the rest of my life is not going to be a good thing for you. You might want to loosen up a bit and be like, okay, my expenses are actually going to be a bit higher because I want to be able to travel, or I want to be able to engage in this hobby or something like that. And also don't forget to adjust for inflation. Inflation is probably going to go up between 2 and 3% a year for the next however many years. I'd recommend more in the 3% range when you're thinking of inflation, just because the aim for 2%, it's usually a bit above 2%. And then some years, like these past couple of years, are even higher than that. So just adjust for inflation and make sure you're aware that how much money you're spending now is not how much money you're going to be spending 10, 20, 30, 40 years from now. Okay. And then when you realize this, you can say, okay, I know how much I spend. Let's say you spend $50,000 a year, and I'm not going to adjust for inflation right now just because I don't want to have to do that math. But say you spend $50,000 a year, you know that, so you need to have that much money. Now you need to know what's going to cover that. Okay. And we'll talk about that. But depending on the type of investment you're in, your way of approaching how much you need to cover those expenses will change. Okay, second question. When do I want to retire? So you need to know how much you spend every year, but you also have to pair that with when, right? If I am a 20-year-old and I want to be able to spend $50,000 a year, how much money I need to put into my investments is drastically different than if I am a 50-year-old who wants to retire in 15 years or 10 years, and I want to spend $50,000 a year. And of course, it depends on how much money you've already got saved and so forth. But the point is that your timeline makes a big difference. Okay. Do you want to retire at 65? Are you sure you're going to be burned out before then? You want to be retired at 55 or 52 or next year or in 10 years? Whenever you want to retire will really determine the best strategy for you. Taking 10 years to accumulate $1 million requires a very aggressive strategy for an average income earner. But 30 years to accumulate $1 million is actually rather conservative. Most anybody could do that relatively easily. It takes a little bit of planning and putting money aside, and you probably need to increase your income so you can put more money aside. But like it's a very conservative strategy, and your investments don't have to be aggressive to get there. So choose when you want to retire. I don't care if you want to retire in 5 years and you're like, there's no way I can make it. Be aggressive about what you want your timeline to be if that's what matters to you, And you might be surprised what you can accomplish in that time. You might not hit your goal, but having that, power goal, like I want to be retired in 5 years, could really push you to make it a lot sooner than you would otherwise. So be honest with yourself. When do you want to retire? If you're, really young, obviously it's gonna be farther out. If you're getting farther along in your teaching career, it might be closer. And of course, once again, it depends on how much you have already set aside. But just keep that in mind that you need to know what your target date is when you are making these decisions. Okay, then the third question. What is the best investment vehicle to get me there? It's not going to be easy necessarily to decide the best vehicle because there are so many options for teachers. We have way more options than most everyone else. Because like if you work at a regular job, you have a 401k. That's your option. That's it. You can invest in an IRA. Most people choose not to, because they just have their 401k and it's automatic and they don't even think about it. But as a teacher, you have a 403b, you have a 457b, most likely. You have an IRA, you have your pension, which is something that you invest in automatically without even having a decision. Taxable brokerage account. That's where you just put money in without getting the benefits of like a tax break. You have an HSA most likely because schools are offering HSA plans more and more these days. You probably have a Roth 403b, you probably have a Roth 457b, you probably have a Roth IRA. All of these options are out there and you need to figure out what is the best vehicle for me to put money in to get me to retirement. Now, one thing to note, these vehicles are not investments, right? A 403b is not an investment. It is a place to put money to invest from, okay? So like if I put money in a 403b, but I didn't choose to invest it somewhere, it would sit there in cash in my 403b and would do nothing. So that's just a very important side note that you need to have an investment inside of these options. And we'll talk about that here in a second too, but that's just a very important distinction. I've heard horror stories of people who have invested for 30 years, but they were just putting money into their 403b, but not investing it in their 403b. So they didn't have any growth on their money. Very, very sad. A 403b is a 403b is generally speaking going to be a long-term investment because it is you're deferring your taxes, so you're going to pay taxes on them when you retire, and you want your money to have time to grow, so you put money in 403b. Generally speaking, like you have a lot of time, you want that to sit there and grow. Another thing is your pension is once again automatic, but that's part of your long-term strategy as well. Midterm, if you want to retire a bit sooner, you might want to consider an IRA or 457b, and that's because these are more in your control. And I mean, you still need a good amount of time for that investment to make any money. Okay, so don't think like, oh, 10 years I can invest if I can retire if I invest in these things. The investments aren't going to be any better in these options. They're not going to grow any faster, but you just have more control of the money in that mid-range with an IRA and with a 457. The 457, for example, when you leave your job, you can now access those funds penalty-free. You still have to pay taxes, but you can access those funds penalty-free. So that makes it a better midterm option to have money in there. And then short-term, having the Roth options are good short-term simply because when you if you need to access that money, any money you put into a Roth option, not the growth on it, but any money you put into a Roth option, you can pull it out penalty free. So that could be helpful when you are trying to retire quicker to put some money into your Roth option. Also, the taxes are paid up front, so that way that money is not taxed when you pull it out. And then taxable accounts are also very liquid, very accessible. So if you just want, some money to grow over, the next 10, 15 years, maybe that's pretty short term for investing. And you want to be able to access it very soon, a taxable account could be a very good option. And then an HSA, the health savings account, I'm going to do an entire episode on why these things are amazing. But they're never really a bad idea. Like I cannot think of a reason why an HSA, if it's with a good provider who's not charging you an arm and a leg, just the privilege of having an HSA. And if they are allowing you to invest that, to grow it, HSAs are great. They're fantastic. So I would recommend those as well. Do your research on that. Listen to the HSA episode when that comes out, because that could be a really good investment vehicle for you. Now, you have all of these buckets. A 403B, you can put in like 23,000 or something right now. I don't remember. I don't know the numbers off the top of my head, but you can put in a lot of money in that. 457, you can do the same thing. So we're already at putting in like $45,000, $46,000, somewhere around there into these investment options every single year. An IRA is another 7 or so, so we're up to like 52. And then you have, your HSA, which is about another 7 if you have a family. So that's, 59. And then, your pension plan is already money going out of your paycheck without even deciding whether or not it comes out. So already you can put most likely, if you have a median teacher salary, you can put your entire teacher salary away into these retirement vehicles. So filling all those buckets sounds impossible. And on a single teacher salary, it probably is. Okay. If you have 2 teacher salaries and you were really dedicated to scrimping and saving, you could probably fill your buckets for one of you. I don't think that you'd be able to fill the whole $100,000 for both teachers unless you had like another side job that was just bringing in the dough. But still, your point is you have a lot of options. You have a lot of money to put into those things. So we'll talk more about how you can increase your income so that way you can put more money into these at another time. But just keep in mind that you have a lot of money you can put away every single month or every single year for your retirements. And that's an incredible benefit that most people don't have the option to do. Okay. Now let's talk about what you should invest in. So we have those 3 fundamental questions, but now you need to know where to actually invest that money. Quick disclaimer. I cannot, for legal reasons, give you specific advice. I can't say, okay, yeah, make sure you go invest in XYZ company because XYZ company is on the rise. And, I'm not doing that. Okay. And if there's an actual XYZ company, I apologize. I'm not trying to bash you. I can give you my general advice of what I think is really good. But the disclaimer is make sure you do your own research and figure out what the best option is for you. So generally speaking, broad market index funds with low fees have the highest return for the lowest risk. Okay, so we're talking about an S&P 500, broad market index fund, or a total stock market index fund is also another one. So a classic example is VTXSAX, which is the Vanguard total stock market index fund. People talk about that one all the time. I don't know all the other ones, but any reputable company you go to, whether it's Vanguard or whether it's Charles Schwab or it's Fidelity or any of these large, well-known investment firms are going to have a index fund that you can invest in. If you are talking to one of these advisors, they are not going to recommend an index fund. One of these people that show up and be like, hey, we should get you an investment in a 403B because it's for your future. Have a donut, right? Those people, generally speaking, are trying to sell you life insurance. Now, life insurance has its place. Generally speaking, term life insurance has its place much more than life insurance for like a whole life insurance. But the thing to remember is that what they are trying to get is their own livelihood, which means they have to charge fees. And I don't like the way they do it, but they do. So those fees mean that they're going to try and get you in a fund that's going to pay money into their pocket most of the time because they are not required to do what's best for you. So since a total market index fund usually has low fees because they require very little management, they aren't going to recommend those to you. They're going to recommend those insurance products or other actively managed funds, which studies have proven that actively managed funds just underperform the market all the time. Like it's just you cannot have an actively managed fund that outperforms the market long term. It's never happened. So that's something to keep in mind, that you need to choose something with low fees that's going to grow. And if you want just minimum risk, long-term growth, an index fund is probably the best option. I don't recommend going for the individual stocks. If you are really into stocks and you spend a lot of time studying them, maybe. But if you're, Uncle Larry says, hey, I got a great pick on XYZ company, you should totally buy into it, put all your money in it. There's no way you can lose. Run, okay? The stocks that are individual stocks are like gambling, because you're betting on that stock to go up compared to everyone else, and they could go down. And if they go down, you have no recourse. But if you have like an index fund, right? Say you have the S&P 500. It's the 500 top companies in America. They go up, they go up, they go up. And if any one of those companies goes down, it can go down so far that it falls off the list and another one replaces it, which is a better company. So they keep going up. It's a brilliant system to have the index funds, because while they can go down in the short term, unless the entire country is completely destroyed, they won't go down long term. It's not possible for over 50 years for these funds to be worth less than they are now, because they have to keep going up by the principle of what an index fund is. The better companies will always be added to these indexes and grow and grow and grow and grow and grow, while the worst companies will drop off and be replaced by better companies. So unless America is gone, which means you have much more to worry about than your retirement, these will continue to grow over the long term. Now, over the long term, keep that in mind. That does not mean that you cannot lose over the short term with these, because the market does drop a number of years over the long term. But just keep in mind that over the long term, this will, if past performance is showing us anything, will continue to be a good investment option. Okay, let's say you don't want to invest in the stock market or even use one of these investment vehicles necessarily. There are other investment options for you to be aware of. Unless you want to dedicate time to these, though, I would not recommend starting here. Okay, just investing simply in those investment vehicles and investing in index fund, that is the easy way to just make sure you're growing your money. But if you'd like to invest in other options, you can look into things like real estate. That takes a lot of time and knowledge, but it is a good investment option if you are willing to put in that time and get the knowledge of how to do it. Startups and venture capital. This is another option that can really grow your money, but it is much, much more risky, much more likely to lose everything on those investments. So unless you have a lot of extra cash, I would not recommend those necessarily. Peer-to-peer lending. This is kind of risky as well, but it does offer a decent return, because you're offering lending to people who can't get lending from a bank. So they're riskier borrowers, but because they can't get it from the bank, they get you get to charge them a premium on those investments. Starting your own business, you're a teacher, I understand that. So this isn't always the best option. But if you can start a business that doesn't require you to work on it full time after you've built it up, you can either have it run without you, 10, 20, 30 years from now, in which case it's just bringing in income for you, or you can sell it, and that makes it a great investment. And then, there's like cryptocurrency, but I don't even consider that an investment. It's very volatile. You could easily lose your shirt, and too many people just invest in crypto because their friend said so. That's not a good reason to make an investment. You need to understand it, and if you don't understand it, don't do it, okay? So last idea here before we wrap up. You know how much you spend every single year, and when you want to retire. How do you know when you're ready? Well, if you spend $50,000 a year, you can do some rules of thumb to determine how big of an investment you need. So $50,000 a year is around $4,000 a month. It's a bit more than that, but $4,000 a month, let's say, is what you spend. And let's say your pension, because you have a pension, is going to bring in $2,000 a month, right? So that means you need to make up the $2,000 difference. Now, your pension would probably actually be more than that in this situation, but I'm not going to go there right now. Just for math's sake, I want to make us realize that your pension is going to take a chunk out of your expenses. Now, if you do not have a pension, some people don't. I don't, for example. But I've been in pension systems. I just don't have a worthwhile pension because I've moved around so much. Or if you just don't want to, bank on your pension because you're a little worried that your pension system is not stable, then you can pull that math out, or maybe cut it in half, or just adjust accordingly. But let's say you get a pension, $2,000 a month. So you have $2,000 to make up. So that means you need to make up $24,000 a year in income. Well, $24,000 a year, if you take that number and you times it by 25, so 24,000 times 25 tells us that you need to have $600,000 invested. Now, why is that? Well, there's something called the 4% rule, which I can do an entire thing where we talk about that later. But the idea here is that if you have 4% withdrawn from your total stock market index every year, over 30 years, you will not run out of money. Okay. This is a very strong study that shows this, using historical data. Out of all of the different 30-year periods that they studied, only one 30-year period got down to zero using the 4% withdrawal rate. And that was a really rough period back in the 60s, 70s, so forth, with stagflation and all that. So 4%, very conservative number to withdraw 4% adjusted for inflation of your retirement portfolio every year. So $600,000, 4% of that would get you that $24,000 that you need for the year to survive. And that means that you should be able to survive for 30 years after retirement or longer, because remember, if it didn't go to zero, that means that you kept having more money, so you can last even longer. So that's how you handle that with like stocks. If you have real estate, that's probably going to bring in cash flow. So cash flow, it's kind of like having another pension. People are paying into your paying to you with rent. That's that. And then these other options, if they are either paying in with profit, if you have a business, or appreciation, if you have crypto or things like that, where you can sell it off slowly over time, you would use those similar rules, right? Cash flow is just apples to apples, right? Do you have $2,000 of cash flow coming in, $2,000 of rent coming in, right? That's pretty easy to figure out if you have that. Or do you have the 4% rule type of thing going on, where you're withdrawing from how much that, say you had $600,000 of cryptocurrency, right? You can still use the same 4% rule for that, because crypto doesn't pay you out rents. It pays you by selling it off. So that's the same idea there. Okay, so as a quick review, just remember that to be financially independent, you must invest for your future. Your investment strategy depends on the three big questions. How much do I need to live on each year? When do I want to stop working? What is the best investment vehicle to get me there? And then remember that investing in the broad market, low fee index funds are historically the easiest way to get a decent return, but you can invest in other options depending on what your goals and strategies are to get there. If you have any questions, feel free to reach out. You can send me an email, Shaun, SHAUN, @teachermoneyshow.com. And you can look at our show notes at teachermoneyshow.com/podcast to get the show notes for all the shows that we have here. And please share this show with a friend, a teacher friend who can use this, because, let's be honest, every teacher friend that you have could use this information. If you'd like to come on the podcast for coaching, to share an expert opinion, or just to talk about a topic you think is relevant, I'd love to talk to you. Just fill out the form at teachermoneyshow.com/guest. I look forward to talking with you.